Lesson 3. Elasticity and Government Intervention. How responsive are buyers and sellers to market changes? We measure this using elasticity. Price elasticity of demand is the percentage change in quantity demanded divided by the percentage change in price. Using percentages lets us easily compare different products. If demand is price inelastic, a firm can actually raise its price to increase total revenue, because the percentage fall in quantity will be smaller than the percentage rise in price. We also look at income elasticity of demand. For an inferior good, this value is negative because higher income actually reduces demand. Next is cross-price elasticity. If this number is positive, the two goods are likely substitutes, meaning a price rise in one raises demand for the other. On the production side, price elasticity of supply tends to be higher when firms have spare capacity and can expand output quickly. Sometimes the government steps into these markets. If they set a legal maximum price below the free market equilibrium, known as a price ceiling, it creates a shortage because quantity demanded exceeds quantity supplied. Conversely, a minimum wage set above the free market wage creates an excess supply of labor, leading to unemployment. Governments also use taxes and subsidies. An indirect tax shifts the supply curve to the left or vertically upward by the tax amount. When demand is more inelastic than supply, the burden of this tax falls more heavily on consumers. On the other hand, a per-unit subsidy lowers producers' net costs, shifting the supply curve rightward and generally lowering the market price paid by consumers.